Hello, and welcome to Idea to IPO. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates LLP. I work with emerging growth companies throughout their life cycle and with investors as they deploy their capital into those investments. K&L Gates is a fully integrated global law firm with over 1,900 attorneys in 40 different offices and on 5 different continents. We've got a fantastic panel for you today. We've got Leo Banchik, who's partner at Global Founders Capital, Emily Fritze, who's a principal at the Wesley Group, and Adrianna Alterman, who's a director at Salesforce Ventures Impact Fund. I'm going to allow them to introduce themselves in a moment. But before I do, I'd like to let you know how today is going to proceed. So we'll have about 60 minutes of panel discussion. After that time, we'll take questions for about 30 minutes. If you've got questions, terrific. Please use the Q&A function. We won't be monitoring the chat. A couple other notes. Today's event is being recorded. So the plus side, if you miss some or all of it, you'll be able to catch it later. On the downside, it will be available later. And so please don't share any confidential information with us. It's not an appropriate venue to do that. Additionally, I'm going to be running all the tech in the background. So if I appear to be fidgeting and looking around, it's not because the panel is uninteresting, it's just because I'm trying to keep everything working. One other note, we would love to know who's in the room today with us. So if you please haven't already, please fill out the audience poll. We'll go over that a little bit later. And if you're not live with us today, we still really appreciate you viewing. So we're excited to have you view this panel as well. Now, with that in mind, let's get started. So maybe we'll start with you, Leo. If you could provide your background information, your fund, and the space that you play in.
Sure. So my name's Leonardo Banchik, based in San Francisco. I'm a partner with Global Founders Capital. I run our climate tech investments globally. We're an early stage fund, typically pre-seed, seed, opportunistically Series A. We do hardware, we do software. We're actually a generalist fund, but I just focus on climate particularly. We are a life cycle fund. So for a portion of our fund, we'll continue to invest until exit for a portion of the portfolio. Before GFC, I've been at GFC for about a year. Before that, I was at McKinsey for almost 5 years doing work in sustainable investing, decarbonization, energy transition, ESG, all the feel-good stuff. And before that, I did a master's and PhD in mechanical engineering in Boston at MIT, specifically in thermodynamics, energy conversion. So very passionate about these topics. Before that, did a little bit of work at the DOE, 2 national labs, and started my whole climate journey in 2006 doing solar research in my undergrad in Las Vegas. So have been through a couple of cycles and just very happy that the world is focused again on climate and on investing to make the world a better place.
Well, fantastic, Leo. We're very excited to have you here, and we're also excited for your help kind of in bringing this group together. Emily, tell us a little bit about yourself in the Wesley Group.
Great to be on the panel today, and hi everyone. I'm a principal at the Wesley Group. We're a venture fund in Menlo Park. We've been investing for 15 years. We focus on energy, mobility, industrial tech buildings, and cybersecurity. So we invest in climate and sustainability, mostly software and digital solutions, but we also kind of straddle some of these adjacent sectors. Some of our notable portfolio companies that kind of help illustrate what we look at. We were early investors in Tesla, in a company called Planet, in Luminar, a LiDAR company, early investors in a cybersecurity company called SentinelOne. And we've invested in a number of earlier stage companies focused on smart charging for EVs, as well as supply chain traceability and more. And a little bit on me, I have been at the Wesley Group for 3 years now investing. Before that, I was helping run an incubator and a seed fund called Powerhouse in Oakland that invests and helps enable early stage startups at the pre-seed and seed stage in climate and energy. And then before that, I spent about a decade in DC working on the political side in energy and climate at the Department of Energy, at ARPA-E, and then in the Obama White House in an energy, climate, domestic policy role. So it's great to be here with you today and look forward to the discussion.
Fantastic. Well, we're delighted to have you back, Emily. And last but certainly not least, Adrianna.
Thanks for having me. Hard to go last after those amazing bios. I'm decidedly less interesting. I'm Adrianna. I am a director on the Salesforce Ventures Impact Fund. Salesforce Ventures is the VC arm of Salesforce. And Salesforce actually has one of the largest venture capital funds inside of a corporate in the world at this point. So we do all enterprise software investing. You can think about companies like Zoom, Dropbox, Twilio, Snowflake. Basically any large enterprise software company of the last few years is probably a Salesforce Ventures investment somewhere along the way. We invest for financial return, of course, but also to expand the Salesforce ecosystem and the network for enterprise software applications. Back in 2017, Salesforce was one of the first corporates to launch an impact fund within its corporate venture arm. I was very lucky to join and kind of help at that point. The idea of working for a corporate didn't even cross my mind at that time, but I'm very glad I did. We have built the fund, the impact fund, to now be well past $150 million. We invest Series A and above, so A, B, C, D, E, and F, and G, and on, I guess, especially in this environment. I certainly invest in climate, but I also invest in ed tech, social sector tech, and financial inclusion, digital health, a broad range of sectors, all but companies that have a social or environmental impact with their product. We focus directly on impact and not necessarily on ESG, we'll get into in the panel. My background is in impact investing. Prior to Salesforce, I worked at an innovation incubator and launched a social impact venture capital fund, structured social impact bonds. And like Emily, also very early in my career, I was also in politics and policy, which I think is often a feeder into this world. So happy to talk about that as well.
Well, thank you. Thank you very much, Adrianna. It's great to have you back. Before we begin the panel discussion, let me just give a quick recap of who is in the room today. So in terms of geographical location, no surprise, we've got a strong showing from the Bay Area, 36% with another 31% coming from the rest of the United States. And then we've got North America making up almost another 10%, 13% from Europe, and then Africa, 6%, Australia, 2%, and a couple, well, 2% from Asia. And then as is, we've actually, yeah, we've got a pretty good mix here. 20% first-time entrepreneurs, 20% early stage companies. We have a few serial entrepreneurs and a few venture investors as well. And then of course, some folks who are students or in academia. So glad you're here with us. And if you're not live, that's okay. We're glad that you're going to be watching on a time-shifted basis. So maybe, Adrianna, if we could just kind of pick up with you and talking, you know, there was a comment that you made just a second ago and talking about this, the sort of current state of investment and venture, and just maybe talk briefly about what we're seeing shake out in the last 6 months, both maybe in venture in general, and then also more specifically with climate and energy tech.
Sure, happy to start. Well, it's no surprise to anyone that the economic environment has changed, is changing, I should say. We are certainly in the midst of it. You know, obviously the stock market is down, tech in particular is down enormously. I will say though that, you know, what's happening, I think there's two major themes that we're thinking a lot about internally at Salesforce Ventures. One is within the downturn, which companies are standing out. It is not one size fits all in terms of performance. And two, how what's happening in the public markets is starting to trickle down into the private markets, and what is that going to look like going forward. So quickly on the first point, high growth tech stocks are significantly lower, trading lower than either more profitable tech stocks, or at least those that are optimizing for both growth and profitability. I think previously, and particularly in venture, but certainly on the public markets as well, companies like Shopify and, for example, Datadog, you know, had really, really, really high growth rates, but weren't necessarily optimizing for profitability, were trading exceptionally high. However, those have fallen most. The companies, including Salesforce, that is kind of in between, I would say, but certainly much bigger in size, but is profitable and has operating margin. Those are certainly trading down, but much less so. And so on the second point, what we're starting to see in the private markets is obviously the effects of this. It takes a while for everything to kind of translate and shake out, and you have a lot less visibility into what's happening in the private markets, especially because there's a lot of rounds happening behind the scenes right now to extend runway, and so we don't have enormous amount of insight across the board. However, we are certainly seeing a transition to what it looks like to not necessarily only optimize for growth, what it can look like to not rely on venture funding exclusively as a cash source forever, but to be self-sufficient. We are certainly seeing a lot of tightening. You're seeing rifts, but I think ultimately every company right now is really thinking about what the next few years look like if venture money is not going to flow as easily as it has been. And I know that for us, we've spent a lot of this year with our portfolio and less time on new deals to just make sure that they are set up, that they have cash for the next 2 to 3 years, and figuring out who those partners can be for them if they're not necessarily going to be raising major growth rounds in the future as we thought.
Terrific. Emily, Leo?
Maybe I'll add a few things. I mean, that was a good recap. I mean, I'd say a few thoughts just in general. The markets are down. Yes, the IPO window is closed or, closing fast. So, larger kind of Series G companies might go to, H perhaps. But, in early stage venture, I'd say it's a little bit more insulated. I'd say we're asking a lot of our portfolio companies, Adrianna, you'd mentioned the word runway. We're asking a lot of our portfolio companies to try to have 24 to 36 months runway in case this bear market that we're currently in becomes an actual recession, and it becomes much more difficult to raise. That's venture in particular, venture in general, but then in particular for climate, I gotta say, we feel somewhat insulated from what's happening. The Inflation Reduction Act, which I know we're going to talk about later, gives some wind in the sails. A lot of funds have raised a lot of dry powder that needs to be allocated. There are still founders waking up every day, coming up with new ideas to really tackle climate, be it through software or through hardware. So, I've seen valuations come down a little bit for early stage startups, which is a good thing for investors, but there are still great ideas. And heck, I mean, even this summer I thought was going to be a little bit slower, but we're still evaluating many startups. And so to pull back, I'd say, climate. So early stage seems to be a bit more insulated than late stage. And then climate in particular seems to be a bit more insulated. Emily, is that kind of what you're seeing as well?
Yeah, I think everything you all said is exactly right. The only thing I'd add on the climate and maybe macro environments too is just that not every company is equal, and that is to say that there's still enough money sloshing around in the private financing side that certain companies that are command a sort of halo, either it's the team, either it's the space, maybe a little bit of traction, have, as we've noticed, still been able to go out and raise at the valuation expectations that they were hoping for. We'll see if that changes. Whereas there is a sort of return to principles, a return to assessing companies based on their financials, their growth, their burn, for kind of the rank and file investments across the board. But I think some companies are still going out there and sort of achieving that valuation expectation that they were hoping to get, and that we saw a lot more of in the last year and a half.
Thank you. So I guess maybe kind of picking up on that, I'd love to learn just a little bit more sort of prior to talking about the Inflation Reduction Act, which we're going to talk about in a second. I think that really sets the stage for a lot of things kind of moving forward. But you talk maybe about some of the fundamentals or other things that you've seen that have sort of insulated the climate space up until now. And I say kind of prior to the Inflation Reduction Act, in part because, it seemed like we were going to get it, then it seemed like we weren't going to get it. And it's back. And, it's going before the House tomorrow, I believe.
Kind of the other reasons why climate's insulated. I'll take a quick swing and then would love to hear my co-panelists chime in. I mean, there's just pressure on all sides for climate right now. We had a clean tech 1.0 boom and bust 10 years ago, or what is it, 12 years ago now, and it didn't work. And I wish it had, because now we're behind. And so carbon removal now, something that I thought we'd never really consider, pulling CO2 out of air. It's just so expensive energetically and economically, but now there are actual companies doing it and raising a lot of money because we've overshot our budget, our carbon budget. And so what I'm trying to underscore here is it's extremely important for us to get our carbon budget under control to get to 1.5C. Otherwise, we're going to continue to see disastrous effects of natural disasters around the world, et cetera. So I think where I'm going with this is that there's pressures coming from all sides for this to happen. And that's why we're seeing it manifest in policy changes like the IRA here. In Europe, disclosure policies that are kind of pushing the whole space forward. So on the policy side, it's pushing climate forward. On the investor side, if you think about, if we're really going to remake this world into a green one, every single industry needs to go through its own industrial revolution to either electrify or decarbonize. And that, for investors, that means a lot of money. In addition to doing something purposeful, you can make great returns. So there's pressure from the investor side. I think consumers, especially Gen Zs, they want to see, their brands having being ESG friendly, caring about diversity, about stakeholders, not just shareholders. And so it's kind of like we've reached this zeitgeist moment. I think COVID helped spur that on, where all signs are pointing towards we need more climate tech and we need more action here. And I think that's what's been insulating the space a little bit. Also, let me say one more thing. Also, the fact that a lot of these technologies have been under development for a long time, and now with maybe a little bit of policy help are going to start to become in the money. So they're going to be cheaper than the status quo. Solar, wind are already cheaper than new build fossil and coal in many parts of the world. And so it's economic sense that's going to make it happen, and not just altruism.
Well, maybe this, unless Emily, you've got a comment, I was going to maybe provide just a quick overview of what's in the IRA for the viewers. And then I was going to ask you, Emily, to sort of maybe talk about sort of how that impacts climate and energy investment. So just super high level, we're talking about basically $369 billion in climate investment in the form of investments in tax credits and other loans, with $161 billion being allocated to clean energy tax credits, air pollution, hazardous waste materials, and transportation infrastructure, $40 billion, $37 billion to clean manufacturing tax credits, individual clean energy incentives of $37 billion, clean fuel tax credits for $36 billion. And the reason why all this is coming up sort of on the tax credit and side is because of the way that they had to, in order to get the bill through Congress, they needed to use the line item means of doing it. And so it's all in the form of basically like tax and spending. So there's obviously quite a lot of money here. Emily, could you maybe share with us how you think this will impact climate investment and energy investment, in the sort of horizon that we see for a typical venture investor?
Yeah, I think sometimes policy is the impact of policy is overhyped. And I think the important message around the Inflation Reduction Act is that this is monumental and is probably one of the most significant climate policies that the US has ever passed. And it certainly is the sheer amount of funding. We saw a huge amount of money allocated in the Recovery Act back in 2009, which really put a lot of investment into R&D and specific technologies. But this is an order of magnitude larger and more significant. And I think, one thing that's really stood out to me is that the tax credits, which are mostly going towards, in many cases, going towards existing, solar and storage or solar ITC, which we've had for a while. Those are impactful because they continue to provide permanence. They can continue to provide signals to the markets around those being in place for the longer term, which was not certain. But then there are new tax credits to expand, those subsidies for new technologies, including storage, including heat pumps, including, effectively electrification of residential and consumer properties. And that is new and notable. That makes that a much more viable option. And there's a ton of companies on the investment side that we see that are in one way, shape, or form working in these areas. But in addition to that, there are tax credits for a variety of other sectors, for a few that were mentioned, for industrial cement and steel, for nuclear. There are provisions around, methane and creating a price on methane, a market on methane. And so the bill is so holistic, is so broad that whereas we may have seen specific sectors like solar bolstered in the past, I think, what's so significant about this is that it's really across the broad renewable energy and decarbonization spectrum. And it's really impacting a variety of different sectors and technologies in a meaningful way that I think we won't entirely understand, for probably a few years.
And how is that maybe translated in terms of, and maybe it's a little too soon to process because like this is literally sort of in progress. But in terms of maybe even opening up other industries or other verticals that previously either we didn't think it would be ripe for commercialization and ripe for venture investment. I mean, do we see any sort of tailwind effect getting picked up from this? No.
Go for it.
Yeah.
Go for it, Emily. I'll follow
Yeah.
on.
I mean, definitely. I think, sort of the message from what I said before is that some of those sectors I mentioned, investors have, it's not to say that they open up new investable opportunities, because I think there's already quite a few climate investors investing in those spaces mentioned. But what it does is it creates much more near-term commercial viability in markets for some of these technologies. Whereas, a lot of these investors might have been underwriting commercial viability in 10 years. This might bring that commercial viability, that cost down curve, and the economic case for these technologies to displace existing fossil fuel solutions, for example, much sooner. And that is why it's so impactful, is that it really changes the timeframes for making those technologies actually cost competitive, actually viable, actually commercial, when in fact a lot of them are, still in that R&D phase. So it's there's certainly, I think this certainly creates new investable opportunities, but more so almost gives more confidence to existing areas that investors are investing in, but maybe some investors were a little more reluctant about, given some of the timeframes or certainty or cost curve, et cetera. But Leo, do you have any thoughts on that?
I was actually going to say the same thing. So we're spot on. I think investors were already making investments in DAC, direct air capture. So my fund, for instance, we backed Climeworks, I think earlier this year. Based on, what were we underwriting? It was a different partner that led the deal, but we were underwriting, the voluntary carbon markets, pricing carbon high for, highly additional, highly permanent forms of carbon removal. They were underwriting corporate altruism to some extent, in the Stripes of the world continuing to buy these, high profit margin tech companies buying these to offset their difficult to decarbonize scope 1, 2, 3. But now there's a big tax credit in the IRA, right? So it makes the investment more, it makes it a little bit more commercial. Same for, can't mention the companies that I've invested in, but there's two, one that does sustainable aviation fuel, another one that does bioenergy carbon capture sequestration. Both will, not immediately, but they'll feel at some point the PTC for sustainable aviation fuel that's in the bill. and the increased 45Q tax credit for CCS. They were already going to be, the one that does BECS was already going to be in the money based on what they're doing, but the increased 45Q credit just makes it more sweet. So it'll accelerate timelines and it'll accelerate commercial viability for a lot of the hardware startups and the software as well. There's maybe Adrianna can comment on that one too, given the software focus.
Sure. Well, first off, I think it's important to, I mean, this is an obvious point, but, you know, as Emily said, this is monumental. And I think a lot of us had, I'll speak for myself, lost hope that this was really on the table, and it came somewhat as a surprise. So I think just digesting what this means is still kind of in flight. But I was very happy to see this happen, particularly, I mean, obviously for the market, but even for some of our companies that are, you know, we're kind of staking some of their future growth on opportunities within it. But I'll just compare actually the difference between what's happening today with this climate bill to what happened during COVID. Because so I invest a lot in ed tech, very different sector, but obviously during COVID, there was a lot of relief money that went directly to schools, districts, specific programs, childcare, et cetera. Those were direct grants, and they were essentially one-time allocated funds. That led to a lot of venture investment, backing companies that could take advantage of those sources of capital, because all of a sudden the buyers had more money to spend, and frankly they were pushed to digitize probably on a 5 to 10 year ahead time frame. However, the question for every VC looking at ed tech deals at the time was, how long-term is this funding? You know, when we get to a renewal cycle, if this is a one-time grant, is this actually a meaningful change to the market? Will those buyers, those districts come back? And where are they going to get the money from in the long term? You know, there's different answers to different ed tech companies. I won't go into which ones on this call, but this is really different. This is not a one-time grant that is going to kind of spark interest in the VC community that may die down in the future. It's structured, as we talked about, as tax credits mostly. They're kind of like fundamental changes to the market and funding for the market that is more sustainable. I think Emily used the word permanence. I think that's a really important distinction with some of the changes that are going to happen in climate as compared to some other programs or government money that has affected other VC sectors in the last few years. And I think that's really promising.
Yeah, and one other area that we haven't mentioned, but is certainly worth discussing is, of course, new tax credits, federal tax credits for electric vehicles with income caps, but 7,500 tax credit for an electric vehicle, 4,000 for a used EV. These are not federal, permanent federal tax credits that have existed prior, and used is new. There's restrictions on these tax credits, and so there's a bit of controversy around how and when they'll actually be deployed, partially because there are sourcing requirements around where these OEMs are sourcing their materials from, domestically sourced materials. So I think that's a sort of interesting piece of the bill worth mentioning. But I think there's already enormous tailwinds around passenger electric vehicles in the US and Europe. And this only, if the domestic sourcing requirements can be figured out, or a compliance structure figured out, this is another piece of the bill that's really impactful. And also, I think, it's great to mention, because this is personally impactful for, people like us who might be interested in making that transition, but, want additional economic or financial reason to do so.
No, that's terrific. I mean, I think one thing, if I may, just sort of maybe shifting a little bit, because I'm mindful that we're about a half hour in, is maybe focusing also a little bit on energy and the impact that the conflict in the Ukraine is having, if any, on venture. And in particular, I mean, of course, I want to acknowledge, of course, that it is been a real hardship for, not only for the Ukrainian people and for a number of other people who've been impacted by it. But what has the panel seen in terms of the impact on venture and, by, what's been going on with respect to, dampening the amount of natural gas and other shipments to Europe, or cutting off of grain harvests, or some of the other impacts that we've seen from the Ukraine conflict?
Yeah, I'll jump in on this just because I think we've made an investment partially in response to what's going on in Europe. I think every time there's any macro geopolitical energy event, it is another reminder that our reliance on fossil fuel is not sustainable, and that there are bigger implications than just the sustainability aspect of relying on oil and gas. And so yet again, the conflict in Ukraine has reminded the world of this, and it's really, really hitting people, especially in Europe, in a big way with increasing gas prices. I think the difference is that this is likely to be a long-term problem in Europe, a long-term issue that the EU has to grapple with, and that consumers feel. And so what that means is increasing pressure to try to reduce the reliance on Russian natural gas. And so what we've seen in evaluating some of these markets is that behind the meter solar, storage, and heat pumps are, rapidly growing markets. And so we had actually looked at a few residential solar companies in Germany and Europe, and upon getting the update, what's clear is they're all doing very well, not surprisingly. And so, we took a fresh look at the European market as a result, and we are actually in the process of closing on an investment in Europe that is focused on PV and also heat pumps. So I think we have looked at this with interest and think that it creates opportunities for some of these technologies. And so in this case, we definitely have made an investment as a result. Not sure though how others are thinking about it.
Yeah, just to maybe build a bit there. It was the kind of in the 70s, there was, the OPEC price hikes on oil actually helped spur the alternative, back then they called it alternative energy, renewable energy movement in the US, under Carter. And so when these shocks happen, folks continue to look for non-fossil fuel based of energy production, non-fossil fuel-based sources of energy, right? And so it hasn't affected our portfolio yet, but I do know a couple of deals that were they were kind of on the fence, a couple of funds that were on the fence on a few deals, and then when the war broke out, as terrible as it is, right? But pushed them forward, given this need for energy independence in Europe. And it's not just on the energy side, it's on the food side. So Jason, you'd mentioned, wheat, right? So I know that there's a lot of food startups that are seeing, kind of increased traction and interest based on kind of achieving food independence, right? I think we see the advantages in being in a globalized society, but sometimes these shocks require us to also think about having some local production, right? And rely less on import. So yeah, it's as terrible as it is, hopefully, there's the silver lining, and that it pushes these industries forward.
Jason, maybe I can take a kind of different stab at this question. I think that might be interesting
please.
For the audience, less focused on the climate impacts, and maybe just pull back the curtain a bit on what it's like for companies to go through these crises. We have supported our portfolio through all sorts of different significant events in the world, obviously the pandemic, but I think what was happening in Ukraine when it first started was kind of another one of those pivotal moments. And just to say, it's so challenging to run a company. It is so hard. We wake up every day with something or other we haven't seen before, unknown, unexpected thing that you need to confront. And I won't name the companies, but some of them had employees fully operating in Ukraine. And, day one, day two was not focused on their business. It was not focused on growth. It was not focused on the climate impacts. It was, how do you get employees out? And just the actual tactical logistics of that. One of our companies had to figure out how to charter a plane to fly in and out of Ukraine. And I think that's just one example. I have many, many others of what it actually took to operate your business in a time of crisis. But I think it's been a big lesson for me as an investor going through some of these moments where that is really the time to lean in with your portfolio. It's no one knows what to do. There's no playbook. We had never gone through a pandemic before. Certainly we have faced wars, but these companies had not. And we, as a society, I mean, but many of them had no, you're really making it up on the fly. And as an investor, particularly for us as a corporate who operates globally and has to also face a lot of these same challenges ourselves, I think that it is such an opportunity, both as an investor, but as a portfolio community to support just kind of the tactical operations it takes to navigate through these crises, whether you are a climate company, whether you are a software company, like these moments in time really affect everyone. And I think that is some of the most inspiring times to be in venture and working with this portfolio. But just to say that, I think it's easy to look back and think about, how this is going to change the world. But when you're in it, it is super challenging and frightening, frankly. And that is also like what this work is on the day-to-day on the ground.
Well, I think that's a great reflection. And actually, I wanted to sort of ask you a question that sort of, I think, dovetails with that, which is, has this also impacted, the way that you as an investor, Adrianna, or the rest of the panel kind of looks at investments where there could be either political instability or hostilities? Because it's a very real concrete example of, things going completely off the rails, if you will.
Yeah, I mean, we think about that when we invest. We also think about that. Salesforce has to think about that when we grow. We certainly invest in all sorts of different markets globally, but also at home. I mean, there's so many geopolitical challenges at home. I think that it's probably, and Leo and Emily, you told me, quite different for a venture fund versus a corporate venture fund, where I think for us, we think about a couple things. One is, where do we operate? Like, what do we know? Where can we help? Where do we want to operate? Certainly we are investing in places where we actually don't have a huge presence on the ground, but we can learn from our portfolio. And we're not shy about kind of leaning into those circumstances and knowing that there will be risks. We have one company that operates across Africa. And I will say the regulatory regime country to country has been unpredictable at best, at times to the point where we thought that they actually couldn't operate. What do we do about that? And I think you really, really, in those moments, we're not telling him what to do, so you really need to trust in your founders. And I think what's been really helpful for us is we invest when we have invested in emerging markets or in new communities or even in new sectors. We've mostly invested in founders from there, we're up there, know the community, and have built the company locally, maybe operated globally at this point or incorporated in the US now, but really know the on-the-ground operations and aren't just kind of dropping into the community or the environment. And I think that's been really helpful to navigate what can be just a really confusing and unpredictable regulatory environment.
Emily or Leo, anything to add, or I'll transition?
All of that, and the world's moving faster. I don't know.
Yeah. No, it's
Go
very
ahead,
true.
Emily.
Yeah.
Yeah, I think most investors underwrite a variety of risks, including geographic risk, but there's things you don't, you can underwrite risk, and I don't know that anyone necessarily would have, there was always a risk of a Russian conflict in Europe, but I don't know that even if you had underwritten that risk in some capacity, that I think most people were surprised. So only so much you can do. That's true.
That's true. We're pivoting and talking maybe a little bit about sort of blockchain and Web 3.0. You've seen any exciting developments over the last, 6-12 months or so? And what does the future look like for that? Leo?
I'll take it kind of like I took the VC question, talking about crypto in general, and then how it dovetails with Web3. I think along with the markets coming down and, public tech, share prices coming down, and with fintech coming down, I think everybody that has a little bit of Bitcoin or Ethereum in their wallets has probably seen the prices come down as well. Bitcoin and, crypto enthusiasts will say, okay, well, there's always been cycles, but we've seen some true disasters this time around with stable coins like Luna becoming, destabilized, lots of folks losing money, carpet pulls, Ponzi schemes, etc., millions being taken from, Axie Infinity through hacks, right? And that was backed by great investors. So I think, it's going through its own cycles, right? It's a new piece of technology. Security measures haven't yet been implemented, and so it's rife with abuse. But I think at the heart of blockchain, there's this underlying technology, this blockchain, distributed ledgers, et cetera. And I think there are some interesting use cases. I'm not a huge evangelist, but I'm also not somebody that's saying that it's worthless. I think I'm somewhere in the middle. And in Web3, I think typically where we see, blockchain being used is for carbon credits or for, tokenizing carbon credits to make them traceable. Also in supply chains, I've seen some use cases as well. Emily, we'll get there in a moment, but I think the Web3 climate intersection, I don't think has suffered as much as the broader crypto space, but it's because it's very new. So there are companies like Flow Carbon, Toucan Protocol, Open Forest Protocol, OneShot.Earth that are out there. And they just all raised money within the last, probably 6 months, I'd say. And they're working actively with, and I'm talking specifically about carbon credit tokenization, because that's where I'm deepest. But there, a lot of these companies are in discussions with carbon credit verifiers like Vera and Gold Standard. And it's all just starting up right now. So the jury's still out on whether this is whether blockchain is a solution in search of a problem, or whether it's an actual strong use case in tokenizing carbon credits. But for anybody interested, there's loads of great news articles out on it. It's exciting to watch because the carbon markets are predicted to be absolutely enormous if we're going to get out of this problem, and blockchain could be a part of the solution. So I'll pause there, but I do think there are some interesting use cases. I'm not sure, Emily, if you wanted to talk about one in particular on the supply chain.
Yeah, I'd say we haven't, to your point, Leo, we have never thought, let's go out and look at every blockchain use case. We have just sort of happened upon use cases where blockchain, problems that were being solved in blockchain as part of that technology stack, typically with other technologies, and then realize that it was a great way to solve the problem. I think there's been a few examples too. A few years ago, there was a lot of excitement around transactive energy, basically using blockchain as the basis to help individuals transact energy by themselves in a residential neighborhood, for example. Interesting, but never really has taken off. We did make an investment in this space in as well as Salesforce. We are co-investors with Adrianna and their team in a company called Circular. They're focused on supply chain traceability, tracing materials, basically, in some cases from the mine through the manufacturing of a product. They also layer in scope 1, 2, and 3 emissions data and calculations, as well as some ESG analytics on the supply chain. And so they're using blockchain as one of the technologies in order to do this and to certify the supply chain as the materials move through it. Interestingly, most of their traction's in electric vehicles and battery components, where they're working with large OEMs like Volvo and Polestar to do this, as well as smaller battery suppliers, and then other use cases like photovoltaic traceability. There, arguably could see some interesting tailwinds with the US Inflation Reduction Act because of some of these material sourcing requirements. A technology like theirs, you could imagine, could become that compliance software to help OEMs prove that they're either meeting these requirements or that they're making progress on them.
Yeah, I'll say for us, Web3 and crypto is an interesting space. I'm on the call with the only company we've invested in climate and Web3 are co-investors here, as Emily mentioned. So I wouldn't say that we've leaned in really heavily on kind of where climate and Web3 meet yet. Well, I'll reveal my personal bias, but then also just talk a little bit about how Salesforce Ventures has approached the broader space. I personally feel like now is a good time to lean in, and maybe not as much last year. Maybe I will be wrong about this, but when we were at the peak, it was a barrage and just extremely hard to navigate and understand, and deals were getting done so quickly that fully feeling like you had a grasp on what was going on felt really unachievable to me. And so we didn't lean into that. I think, frankly, that now that things have cooled off, now is the time when we are starting to really get smart. And I hope that approach will serve us well in the future. But when we have a little bit more time to breathe, to see how the cards fall, and see which technologies actually kind of emerge from what was a very frothy moment in time. But more broadly on Web3 and crypto, the approach that we're taking as a venture firm, but we will also take in climate, is we have a lot less interest in investing in, for example, coins than we do in kind of the picks and shovels. We, at the end of the day, are an enterprise software company. And so we think about the infrastructure that it takes to stand up the broader sector. So you obviously have to believe in the viability of the sector long term to some degree. But I think we are much more interested in investing in companies that are more of that infrastructure layer, that are not necessarily specific to any one chain, and will be able to focus on security, for example, or regulation, or something like compliance, that hopefully will not necessarily be as subject to the vicissitudes of that market. So, for example, Salesforce Ventures invested as a core fund in a company called Block Demon, which is essentially that I just described. And so I think that will be how we approach pretty much all sector-specific investments within this broader market.
Glad to know you're not taking a quarter of all of what's on your balance sheet at Salesforce and putting it in Shiba coin, Adrianna. I'm glad to hear.
Yeah. We have a Super Bowl commercial that may mention something about other tech founders' choices and how they spend balance sheet, but I will let others just Google that.
Yeah, I will say one thing on crypto, actually, just as a small bridge, and I think it's related to the commercial, if I'm not mistaken. Last year, a lot of talented people were going into crypto, and that still might be happening, but I'm starting to get a feeling that a lot of talented people are going into climate, and that's giving me hope, because last year, I don't know Emily, Adrianna, you felt this, but climate was so exciting. And then all of a sudden crypto just, the conversations around it just became so overwhelming, and everybody was, there are some investors that look at where the talent goes. Engineers, where do they want to spend their time? What are the hard problems they want to solve? Andreessen talks about this sometimes, right? But I'm beginning to feel like folks are still going to crypto, that's fine, but more folks are also going into climate. I don't have numbers around this, of course, but it's just a sense that I get that climate is becoming a hot place for people to go spend their time after their MBAs or undergrads or grad school or whatnot.
Yeah, I would say that that's definitely true. I also don't have exact metrics, but anecdotally from our companies, but also what I've noticed is an interesting, it's almost like a sub market, the intersection of workforce and climate. There's all these new companies that are developing training modules, boot camps. Some of them are specifically focused on marketplaces. And anyways, just to say, there's actually this whole other market of training people for the climate future, startups that do this. And so for me, it's kind of fun because it's the intersection of ed tech and climate. But I think that, there used to be one and now I've seen many more. So I think that is a sign that there is certainly something happening there.
Well, maybe that's actually a good segue, Leo, for you to talk about and share your list for those people in the audience who are maybe interested in spending more of their time in climate, some of the resources that are out there. And Adrianna, you might be able to jump in and also share maybe where there's some training is available too.
I'll just give a few that I've found very helpful for those in the audience that are, entrepreneurs or other investors or folks that want to get more into climate. Maybe I'll list 4 here, and then would love to hear my co-panelists. One is My Climate Journey has really good podcasts and job boards that, Jason Jacobs and Cody Sims, they're doing great stuff. They have been for a while. Climate Tech VC, it's a newsletter run by Sophie Purdom and Kim Zhu. They occasionally have job opportunities at the bottom, but they're just very timely, and they get these things out fast. Like the Inflation Reduction Act, they did a good tear down, and I think they did it over a weekend. So it's a good place to stay up to date, but it's kind of a good network to be a part of in the sense that they have the job boards there at the bottom of each update. And they have a list of VCs. If you're an entrepreneur and you're looking at which VCs to pitch to, they have a large list of climate tech VCs, both generalist and focused, separated by stage, et cetera. So that's Climate Tech VC. If you're looking for jobs, I always recommend climatebase.org. I think it's a relatively new job board, but I think they've done a great job in being out there, and they've got some pretty high quality stuff. Climatebase.org, BASE, like baseball. And then the last one is terra.do. They have kind of trainings and different classes that they do, and it seems to also be kind of a network that's out there. So a lot of good ways to plug into the ecosystem. Any others that I'm missing?
I love all of those. There's as you'll find, kind of in this space, a lot of people flow from one to the other. So some of the people at My Climate Journey used to be working at TerraDo. So anyways, just to say, you'll get to know the system. One other, or I guess 2 other companies that come to mind, they're actually startups. They're actually doing kind of on the ground training, particularly focused on EVs, but one is Charger Help. They're an LA based company. If you're actually looking for tactical experience. And then another that is kind of earlier stage, but is also trying to be somewhat of a marketplace, is a company called Greenwork. And they're thinking about what kind of the future market could look like for green talent.
That's a portfolio company, actually, Greenwork.
Oh, it is?
Another partner led the deal on my fund, but yeah, it's a GFC Portco.
But the founder, is a friend of a friend. Anyways, great.
The only other one I'd add is On Deck. They have a pretty solid climate fellows program. So I think in addition to the others that have been mentioned, that's a pretty exhaustive list.
Terrific. And just for the audience who's viewing it, if you didn't catch that list, that's okay. We're recorded. So I'm going to share this with you afterwards, and you can skip to about the 57-minute mark, and you can catch the list again. We are coming towards the close of the hour. We haven't really touched on hydrogen at all, but in terms of clean production and distribution of hydrogen, if we could maybe touch on that for a couple of minutes, if we see any action happening there. Emily, I don't know if you have any thoughts or any observations in the market.
Yeah, and Leo might have a slightly different view, so I think this will be a good discussion. I think our firm invests similar to Salesforce in more digital solutions, business model innovation, et cetera. So hydrogen as it stands would already be a tough investment for us, but we spend quite a bit of time looking at the space in the market. We have a lot of energy utilities who are invested in our fund who are interested in the sector. There's been numerous waves of hype cycles in hydrogen, which Leo, I think you've experienced, you've witnessed, and we certainly over the last couple of years have been in another. I think there are certainly things that are different this time around, most notably for green hydrogen, just the economics of renewable energy has an input. But I think the main question that we have is, one, what are the best sectors for a hydrogen economy in the near term? And so, hydrogen is necessary for decarbonization of certain sectors. And that's why I think there's been a lot of interest, especially with increasing pressure overall around climate and decarbonization, but it's maybe not, quite the right solution for every sector. So Leo and I were just talking about this, which is that our view would be that battery electric vehicles will dominate the passenger vehicle market, and that hydrogen might be more appropriate in some cases for heavy duty or for maritime or other or certain segments within aviation. And so, I think not every opportunity amongst the many that hydrogen could be a solution for is maybe the most investable opportunity, at least from our standpoint. But I think we also just have there's a real question from our standpoint about when market demand actually results. And I think it could be further out depending on each sector than we might want. And so that becomes the question for investors. There's a lot of strategic and corporate money going into hydrogen, or money coming in from funds that have very patient timeframes that are willing to wait 15, 20 years. But if you're a standard venture financial investor where you're expecting returns within a certain time frame, maybe investing in a hydrogen electrolyzer, as an example, might be a harder investment depending on those expectations. But every firm is different.
Yeah, great overview. You definitely need to be patient if you're investing in hydrogen. Another partner led the deal as well at my fund, but we were in universal hydrogen. I do think hydrogen makes sense in aviation, but that is a patient bet. Not only do you need to get the fuel cells and the storage tanks in there, but you need FAA regulation. I mean, before you're going to see these 747s, which can never really work on battery power unless you've got a paradigm shift in multiple step changes in battery technology to give you the energy densities required. You're gonna see hydrogen, but it's going to take 10, 15 years maybe to make that happen. So you start challenging the venture horizons that are expected. But for patient funds, our fund can be a bit more patient for many reasons. That can be a good bet. I think you alluded to it a bit, Emily, and I know, conscious of time, I just want to give a couple more thoughts on hydrogen. It is overhyped, like Emily says. I don't think we'll ever see hydrogen for passenger vehicles, even though I live near a hydrogen charging station in Bernal at the bottom of the hill, and there are Toyota Mirais that go in and charge up. And I think it's super cool because you can see the water coming out the back end of the car, but it's an infrastructure problem. And we already have the electric infrastructure, and batteries are already good enough. And so you will see hydrogen for maybe heavy duty on certain routes, heavy duty class 8, although I think that will also electrify. Aviation, like I mentioned. Forklifts, funnily enough, it seems to be a market. But I think Emily alluded to it, and I want to touch on it, for chemicals and for sustainable aviation fuel, and for, in certain cases, for food. So hydrogen is a base unit. If you mix it with CO2, you can do all sorts of things with hydrocarbons, right? So one of my portfolio companies takes green hydrogen, CO2, and makes complex hydrocarbons to get kerosene, basically drop-in sustainable aviation fuel. There's another company I'm looking at that does green ammonia. What is ammonia? NH3. Where do you get the hydrogen from? And if it's going to be green, it needs to come from a green hydrogen source, right? Like an electrolyzer or otherwise. So and we use a lot of ammonia in our agricultural food systems. And so, there will be markets for green hydrogen. The question is how big and how are we going to do it cleanly? Electrolyzer costs are coming down, but, hopefully with the Inflation Reduction Act, they'll come down even more. I think there's a hydrogen production tax credit being discussed as well. So just full circle, closing the loop back to that wonderful act. And thanks.
Terrific. Well, it's a great panel. Glad to have you all here. It's not completely over at the moment, but we are going to shift to Q&A. But before we do, maybe we could just take 30 seconds or so and go around the horn. Any closing thoughts to any of the audience members that you want to share? And, if you'd like to be in touch, if you'd like the audience to be able to reach out to you, what's the best way to connect with you? We'll start with you, Leo, and then Adrianna, and then Emily, we'll let you get the last word.
Closing thoughts. I don't know. I'm so happy that the world is working on this again. I mean, I just feel like, having started a while back, and there's always a good time to jump in now. If you're not in climate, come join us. It's a fun fight. But I'm just overjoyed that, I still don't think we're moving fast enough, but we're moving, and we're in a better place than when I finished grad school in 2016. It's on the minds of more people, and I'm just overjoyed. So yeah, that's closing thoughts. Find me on LinkedIn. I think I'm either Leo Banchik or Leonardo Banchik. I'm most active there. If you're not in climate, join the fight. If you are, keep doing the good work.
Oh boy. Okay. I guess two thoughts. So one is, this is a weird time, and it's going to be rocky. And I think that is true of venture. It is true for tech. It's true of the broader economy. We don't know how long it's going to last, but things are changing. And I think it's really important to be aware of that, and not, we have our big kind of company-wide review H2 kickoff right now, and our CFO was just presenting last night about this exact thing, like what do we do in these times? And I guess the second point is, it relates to all companies, but particularly in climate. This is not a time to lean out. It's a time to be smart. It's a time to readjust and figure out where you're going to optimize, but not fully pull back. I think that's finding that right balance is going to be the challenge for most companies, particularly venture-backed right now. But particularly in climate, we don't have the bandwidth to lean out. That's not an option anymore. And so my hope is that even with some of the turmoil, I think that, climate is really top of mind for many people, but when you have other significant global events, economic events, sometimes it gets pushed to the back burner again. And so I think it's really important, particularly right now when we are at, frankly, that kind of pivot point, to make sure that of all things we're leaning into, it is climate, and that we're being really smart about the investments and changes that we're making to weather what's going to be kind of a rocky few years coming up.
Yeah, the only last thing I'd say is, I know, over the last couple of years, it's been well documented, well talked about, that a lot of people have moved jobs or are thinking about moving jobs. And, obviously today we're representing mostly the enthusiasm around applying your skills to working in helping solve climate change or technology mitigating against climate change. And I think we're all excited about that. As you can tell, we've shared a lot of interesting opportunities in the sector, but I think there's a whole host of different spaces where, instead of maybe just selling, not to be disparaging, but ads or apps, you really can work on hard problems where there's actual market opportunity, but there's also an opportunity to make a difference and have an impact on big pressing challenges. So whether that's climate or another area like education or health or what have you, I think that would be my main sort of message for anyone who's thinking about what's next or in a current role and maybe thinking about transitioning. And if you want to get in touch, you can find me on LinkedIn. That would be the best way.
It's kind of like, if you're going to work on problems, work on the ones where the externalities are positive instead of negative.
Yeah,
I guess.
exactly. Much more succinct.
My econ background, what can I tell you? Well, thank you very much, panel. We've got some wonderful, we've had a wonderful discussion and we've got some great questions. I see in some of the questions, maybe there's even some foundational information that the audience would like to have. So one of those would be sort of unpacking why we've seen a trend, even though the markets have been down. Certainly, like the public markets have been down, late stage venture has also been, more negatively impacted. Like why are we seeing it sort of safer, or the earlier stage pre-revenue startups being less impacted in this market?
I can start, Leo. I don't know if we'll have different opinions here. We'll find out. So I think a couple things. One is time. It takes a while for things to shake out. And I think that's probably the biggest thing. Early stage companies are much farther away from the public markets and from late stage impacts. And the reason that, growth rounds, and by growth, I mean kind of even mega growth. So like Series D plus, really started to cool down very quickly was because the timeline, the IPO window effectively closed, and the timeline to underwrite to an exit like that got a lot longer. And so what it meant to underwrite a late stage deal got more expensive much more quickly. When you're investing at the early stage, you can kind of squint and assume that the IPO market is going to come back much more quickly, or at least by the time that that company needs, will be going through that route. So I think one is they're just much farther away from the public markets, like structurally, that's the biggest reason. But two is also that this is kind of more venture specific, but what's happened in the last few years is there's been a huge amount of money from crossover funds, which are funds that invest in both public and private markets. Most of them are hedge funds that traditionally had invested mostly public and then pumped a ton of money into the private markets. And that had a lot to do with valuation increases. And a lot of those came at growth stages. So the economics of the growth stage, early stages were not immune to that. There were certainly some really, really sizable valuation change, but the bulk of the money that was spent was in these growth stages, and the bulk of the money that all of a sudden appeared was in later stages. So you just had a lot more companies that were kind of fully funded and with crazy valuation in that segment. So we are starting to see valuations come down at the early stage. I think it is happening more slowly, but I don't expect early stages to be fully immune from what's happening in the market more broadly. But Leo, I'm very curious to hear what you spend a lot more time in pre-seed and seed. I'm kind of thinking like a stage.
Yeah, same thing. Time. They're very far away from the IPO markets. From IPO, there's valuations have come down, but I think it's a good thing. I think they were a little out of hand before. I'm not just saying that because I'm biased, but sometimes you do a disservice by raising, a round at a high valuation, because you're setting yourself up for, quite a big hurdle for the next one. So I think it's been a good thing all around. And I think, I don't know, maybe there's a lot more hope at the pre-seed seed. Maybe we're all deluding ourselves. Like you look at certain technologies and you say, this could be an unlock. If you look at the, techno-economic analysis, what we call a TEA, and you see a product that doesn't yet exist in the market. The incumbents aren't going to really innovate on it, or they're not really doing it. And you see it as absolutely needed in order to get us to 1.5C. You place the bet, it might still be early in R&D, but they've proven some kind of a technology readiness level already. And so at least I mentioned that because I don't like to underwrite any science risk. So I like to see that the thing works on a benchtop. But if I think it's a good team, if I think it can be scaled, sometimes the seed round is enough to. I mentioned runway earlier, right? So sometimes the seed round is enough to last them 2-3 years. Hopefully the economic cycle at the end of 3 years, it doesn't look like it does today. So they can be heads down building with the money we give them today, and then they pop out and they're ready to really, really tackle things. So yeah, it's a combination of optimism and hope and time and, looking for technologies and teams that have a distinctive approach to really have an impact.
Also, there's just a supply and demand, dynamic. There's a lot of capital in the space that was raised over the last 2 years. And so even though firms have slowed in some cases their deployment, there's still quite a bit of capital at the early stage. And the check size, as you can imagine, is a lot less than at the growth stage. So I think there's, it's a bit of like, we still need to deploy this, right? And to Leo's point and Adrianna's point, there's more time to sort of let things play out. Whereas at the growth stage, that time is condensed with expectations for growth itself, but also an IPO.
And the markets don't discourage founders from waking up wanting to create the next Google for energy, right? And there are those that say that the first trillionaire is going to be in climate or energy or some sort. We'll see. But founders wake up with a dream, and I don't think the markets discourage that. So maybe a little bit, but hopefully not too much.
So here is a question, which is, which are the most powerful innovation in climate? What is I think it's supposed to be. So let me paraphrase what I think this question is, which is basically, what technology that is sort of ripe for commercialization, like as of sort of today, do you think has the potential for the most positive impact on the climate? It's sort of off the cuff answer. There are so many out there. Yeah.
I mean, I'll take.
You don't need to limit it to one either. I won't make it one or two.
I'll take a quick hit. The fun thing about climate is that it impacts every single industry, right? Like the TAM is basically, the global GDP, right? It's like it's every industry needs to undergo its own decarbonization journey. It's really hard to pick one. But if I were going to say, a really interesting area for unlock is ag, which I think contributes about 20% of our carbon emissions. Like the food that we eat, the carbon inherent in the food that we eat is just tremendous, both directly and indirectly. And so, I had mentioned green ammonia earlier, but ways to decarbonize the agricultural system or store carbon in the soil. I think that's a huge carbon store. I think that's a pretty exciting space. And there are other investors looking at ag in particular. But I mean, you name it, green steel, we talked about green hydrogen, green cement. Cement contributes like 8% to the carbon emissions. There's lots of great cement companies out there in the early stages doing cool things. But there's a lot of different technologies. There's a lot of different verticals that need transformation.
Yeah, the one that I'd mention, hard to choose just one, and it's not to say that the technology is fully de-risked, but battery storage in the technology and lithium ion itself has the potential to really drive decarbonization of the grid, more renewable deployment, and that is, right for prime time. And of course, the next stage of battery storage would be alternate materials and longer durations, and a lot of that is in development, and I think we'll see a lot of progress on that over the next 10 years. So that would be the technology that seems sort of obvious, but I think is ready for prime time. And over the next 5 years, we're going to see rapid and increasing deployments.
So I think I have somewhat of a annoying answer to this question, which is, well, I'll start out just with the why. We know what's coming. Everyone knows what's coming. To Leo's point, climate is no longer a sector, it's an economy. And however, having people act on that and buy against it today is still really challenging. There are so many companies that are still, particularly in the software side, but I assume also on the hardware side, well, I know on the hardware side, where the threat of what is coming is not actually changing the way people spend money today. And that can be really frustrating and really expensive for companies, because until we are forced to do something, we don't actually do it. And so my answer to this question is actually more of the stick than the carrot. And if I could wave a magic wand, it would be a regulatory change globally, because I actually think that that's not going to happen. So this is the state we're in, and so we have to rely on it should be a both, not an or. But I think that truly is the answer, which is if we were really to wave a magic wand, then and invest all of our money.
A carbon tax, right, Adrianna, or
Exactly.
what? Sorry to interrupt, but like,
Yeah.
what kind of policy?
A carbon tax directly, and then even something frankly as simple, if we're not going to go that far, mandatory reporting across the world would be a really good start. That is aligned, that is where all of the metrics are the same, and where there are severe consequences. I think that would actually change the game in a much quicker way.
I agree. It's such a shame that humans are so reactive and not always proactive, right? So yeah, policy would be great.
And you can't manage what you don't measure. So I think that's kind of part of it too. Maybe actually just fleshing out, because there's a question in terms of like, how does investing in more capital intensive startups versus investing in startups, or excuse me, software startups, just in terms of maybe you could outline the differences to the extent there are in terms of, why, Emily and Adrianna, it sounds like, you focus kind of more on the software side. Leo, it sounds like you're more open to both software and hardware. But in terms of like what the differences are in the processes for how you choose those investments and why is there specialization between the two?
Yeah, I think our firm has an interesting perspective because in our first two funds, we invested in quite a bit of hardware and hard tech with kind of mixed results. And that was, first wave of enthusiasm in investing in climate and clean tech. We had some great results. We were, investors in Tesla back in 2008. And then there were other investments, for example, in biofuels that were really challenging. And I think we have now steered away as a thesis from investing in a ton of a portfolio that's primarily hard tech and with more of a focus on software and business model innovation. And I think that's because what we observed in these earlier investments is just that the time frames in which it takes, even if a company is, let's say, modestly successful in overcoming the technical and commercial milestones that it needs to, the timeframes that it takes often exceed even investors' initial, long expectations. And as a result, the capital that's needed to raise to get that company to be successful is such that it dilutes the earlier investors out. And so, you can even have a company that's hard tech that ends up being successful in eventually, but it takes 15 years, right? And at that point, your investment is no longer valuable, or the return is no longer valuable. And so as a result, we just look for companies, and it could be hardware, but mostly and more likely capital efficient companies where you're seeing, revenues and you're seeing results more quickly, typically within 3 to 5 or 6 years. and and the capital needs are just not quite as great. That being said, we have made some great hardware investments that have been awesome returners for our fund, right? So another example, we were in Luminar, a LiDAR company that's now public, great return for our fund. And so we will reserve the possibility of investing in some hardware companies, hard tech companies in each of our funds. It's just that we think of it as a portfolio approach. And so the bar for those investments is super, super high. And so we're looking for that like Luminar, Tesla-like team that we think is sort of extra special, solving an extra interesting challenge, and has the capacity to raise hundreds of millions of capital.
A quick count, not a counter necessarily, but a lot of the capital, and I'd love to hear your thoughts, Emily, because I've heard this before too, why some funds don't do as much hardware. A lot of the capital that needs to get raised though is project finance, right? And it shouldn't all be VC.
And we're open to those models. Like there's increasingly companies, and this did not exist back in the day in 2008, 2009. There's companies, to Leah's point, that are basically raising an equity stack initially. It's typically maybe even one round, and then once they prove their technology, they're deploying the technology on a project basis, and they raise debt to finance the projects, right? So we're seeing this in EV charging, we're seeing it in aerobic digesters, we can see it in hydrogen, etc. And we would be more interested in those models where we have an opportunity to invest in equity, and it's someone we think has the connections, the ability to raise the debt. So I would say that's an exception for sure, and something that's different about this time around.
Yeah, I think just last thing to add is, hopefully this is helpful for people on the call. A lot of this has to do with the structure of venture. Most venture funds that have external LPs are on a 10 to 12 year timeline. And we won't go into where that number came from. It's somewhat random. It doesn't need to be that way, but it just is for the industry. And to Emily's point, that is not necessarily the timeline on which hardware investments can really scale and grow. So there are other funds that are exploring what it means to extend that timeline significantly, or can be what we call patient capital. Leo mentioned his fund has the ability to do this. Usually when that's the case, you have either a single LP and it's just their own personal wealth, or for example, Breakthrough, which is Bill Gates' fund, has decided on a 20-year timeline for the fund, and has had their LPs sign up to that because they want to make longer term investments and have more patience. So I think I'm excited to see more innovation in the venture model itself, because I think that is actually what is needed to open up some of the opportunity to invest long term. For us, we are, I guess, essentially a single LP fund, but we are really just balance sheet capital. So it is, which means we're a public company. And so what we do with our balance sheet is very public, and we have a huge amount of scrutiny and shareholders who notice. So it's a bit of we can both be patient and not. It's not a kind of clearly defined timeline, but I think that is innovations in venture itself can lead to more investments in different types of technologies.
I agree with all that. I want to add a couple more things too. I know some software investors, pure software investors, if either fintech or and at my fund or elsewhere, angels or other funds. It's a different world, investing in climate, at least the kind of hardware that I look at. It's a different world. If you're doing software, you're looking at how many users did you sign up every month. You're looking at unit economics as well. And I'll get into unit economics for the hardware ones, but you're looking at traction, you're looking at both with folks that you're signing up, but maybe also possible partners that you need. You're looking at the number of times your app has been downloaded, and you're looking at user attrition. There's all kinds of heuristics on LTV to CAC, right? Lifetime value to customer acquisition costs and all that. There's all these heuristics that have been built around this, Silicon Valley kind of digital startup, and what are good ratios and bad ratios. All that gets thrown out the window when you look at hardware climate tech. It's like, you know, are you building, so you're building, let's say, a hydrogen electrolyzer, and it's an anion exchange membrane. So, I mean, you have to know a little bit about, you know, the science and about the tech. You don't have to have done a PhD, but you've got to be a bit smart on kind of the technology, and you got to see where it is in its development. Is it TRL is a very helpful scale for hardware, technology readiness level. I think it goes from 1 to 9. If you're at a TRL of 1 to 3, it means you still have a lot of science to do. If by the time you get to 4, you might start being ready for scale up. And so you have to be able to kind of dive in and understand this, because if you're in the science realm of the TRL, there are funds that will back you, but there also is free non-dilutive capital that you can get from ARPA-E, or, you know, from the government, ARPA-E or NSF SBIR. And so I typically tell founders that are in early TRL stages, go find non-dilutive funding, work on your idea, prove it out on the bench in a lab or whatever, and then come back to me. But so these are all things that you don't need to know when you're investing in digital startups, right? So I'm giving kind of a flavor for why this is different. On the hydrogen electrolyzer idea that I'm giving you I'm making this a bit illustrative here, but, you know, you need to be able to ask questions like, you know, what are the continuous hours of operation you have on the cell? How many times do you need to maintain the cell and come back and replace the membrane maybe? You need to think about the ecosystem of both suppliers that are, you know, giving you the inputs you need to build your technology, but also who's going to offtake the hydrogen at what cost? What's your cost down trajectory? So it's a different set of questions that come in, and a different set of considerations that come in the hardware. A big one too, just quickly kind of tying this off as well so we can get to other questions, but the project finance that Emily and I were talking about. When are you going to build your first plant? When are you going to build your second one? Where are you going to find capital for that? You know, can you raise debt for that? And also obviously the economics, right? We call that techno-economic analysis, TEA, but is some of your revenue coming from carbon credits, right? At what price do you think you can get those credits? So I'm giving a bit of a laundry list. It might not feel very structured, but there's a whole host of considerations that come into effect that aren't just, you know, how many users churned off your product last month, right?
No, I think that's great and very helpful. And I think it also just goes to underscore the point that if you are a founder and you're interested in raising capital, you know, do your homework both on your business and then also in terms of who your investors are going to be, to see if it is potentially a fit. And then you need to be prepared to answer their questions and get ahead of it. And sort of with that in mind, we've got about 1 minute left, but maybe if we could go around the horn again in the same order, you know, Leo, Adrianna, Emily, if you have any closing thoughts before I sort of sign us off.
In that order,
Yeah.
Join the fight if you want to. Now's a great time to join climate tech.
I don't know, not too much that we haven't said. I think that I guess one thing, I was on a for-profit, and venture is not the only way to do this. I was on a call this morning. I was a judge for an amazing organization called Eco and Green. They support social entrepreneurs. And there are some incredible nonprofits that are also innovating in this space in a really incredible way. And so I think that you can think really expansively about what tech or what innovation means. And it's not just focused on venture-backed companies.
Yeah, not too much else. Just thank you to everyone for joining, for your curiosity, and for spending time with us. And feel free to reach out over LinkedIn.
Fantastic. Well, thank you very much. I also want to thank our audience, both in real time and those who are watching on a time-shifted basis. I want to thank our guests, Leo Banchik, Emily Fritze, Adrianna Alterman. I want to thank Idea to IPO for organizing today's event, and I want to thank my firm. And with that in mind, I'll let you get back to building your great companies. Take care. Bye-bye.
Thanks, everyone.
Thank you.